Wealth is built out of surplus cash flow, preserved liquidity, and enough time and productive assets for compounding to do its work. Most people never get there because they keep buying things that convert future investing power into present consumption with negative long-term returns. So if you want to be rich, stop thinking like a shopper and start thinking like a capital allocator. Here is the core idea. The market does not reward effort by itself. It rewards capital that stays invested long enough, with low enough friction, through enough cycles. Your personal finances operate the same way. If too much cash leaves your system for low-value consumption, your balance sheet never develops real momentum. That is why this conversation is not about being cheap. It is about identifying purchases that quietly reduce optionality, weaken liquidity, raise fixed costs, and delay ownership. You need to understand the mechanism. In markets, prices move because of liquidity, rates, sentiment, volatility, and positioning. In a household, wealth moves for the same reasons in different form. Liquidity is your cash buffer. Rates show up in the cost of debt and the opportunity cost of not investing. Sentiment shows up as impulse buying and status pressure. Volatility shows up when income is unstable or expenses surprise you. Positioning shows up in what percentage of your income is trapped in liabilities instead of assets. Most people misunderstand this because they think getting rich is mainly about earning more. Higher income helps, but if your spending system is badly positioned, more income simply scales your mistakes. So let's get specific, because this is where clarity matters. If you want to be rich, stop buying cars you cannot comfortably pay for in cash without weakening your balance sheet. I am not saying never own a nice car. I am saying stop financing status. A depreciating asset with insurance, maintenance, taxes, repairs, and financing cost is not one decision. It is a chain of cash outflows disguised as a lifestyle choice. You are not buying transportation anymore. You are buying ongoing drag. Most people look at the monthly payment and think affordability. You need to look at the total capital destroyed and ask what that money would have become if it had been invested instead. Stop buying housing upgrades that push you into a higher fixed-cost life before your assets can support it. A more expensive house is not just a bigger mortgage. It is higher insurance, higher maintenance, higher furnishings, higher utilities, higher property taxes, and often higher lifestyle expectations. People confuse a house with wealth because it is visible. But rich people are not defined by visible cost. They are defined by invisible flexibility. If your home absorbs too much of your monthly cash flow, you reduce your ability to invest aggressively when opportunity appears. Stop buying designer items, premium branding, and image-based consumption that exists mainly to signal rank. The market does not care what logo you wear. Your brokerage account does not pay a premium for looking successful while you are still undercapitalized. This category is dangerous because it feels small at the transaction level. One bag, one watch, one pair of shoes, one premium gadget. But the biological mechanism underneath it is social signaling, and social signaling is hard to satisfy because it adapts quickly. The moment one upgrade becomes normal, your baseline shifts and the next one feels justified. That is how consumption becomes self-reinforcing. Stop buying convenience by default when convenience has turned into a recurring tax on your future. I am talking about constant delivery, habitual ride services when cheaper alternatives exist, premium subscriptions you barely use, and all the small outsourced decisions that make daily life easy but steadily reduce free cash flow. One convenience purchase is not the problem. The problem is the habit loop. In markets, small recurring fees compound against you. In your household, convenience inflation does the same thing. You do not notice it because it arrives in small monthly fragments instead of one large invoice. Stop buying furniture, decor, and home aesthetics on a timeline your net worth has not earned yet. This is a quiet trap. People upgrade rooms before they upgrade their balance sheet. They want the appearance of stability, sophistication, and success before the financial structure exists to support it. But capital allocated to presentation cannot also be allocated to ownership. That matters. Every non-essential home upgrade made too early delays your investment base, And a delayed investment base means a weaker compounding engine later. Stop buying speculative investments you do not understand just because the story feels urgent. Yes, I am calling these purchases too. If you buy a hot stock, a meme asset, an unvetted private deal, or a trendy financial product because everyone around you sounds certain, you are consuming narrative, not investing capital. The operating mechanism here is momentum. When liquidity is abundant and excitement is high, people confuse rising price with good value. Most investors misunderstand this because they believe the danger comes from losing money slowly. In reality, concentrated enthusiasm can damage a balance sheet quickly, especially if the position size is large enough to affect your behavior. Stop buying education that promises identity instead of skill. Courses, masterminds, premium groups, coaching packages, and self-improvement products can be useful, but only when the outcome is practical and measurable. Too many people buy the feeling of progress instead of the substance of it. They consume motivation as if it were an asset. It is not. If the purchase does not improve income capacity, decision quality, or execution discipline in a way you can test, it is often another form of emotional spending with professional packaging. Stop buying business expenses for businesses that do not yet have proof of cash flow. This is a major one. A logo, office space, premium equipment, endless software tools, elaborate branding, and polished presentation do not create a real business. Revenue does. Rich people protect capital until the model proves itself. Most people do the reverse. They buy the costume of entrepreneurship before the economics are real. You need to understand sequence. First, the business earns. Then the business upgrades. If you reverse the order, you are subsidizing ego with capital that should have remained liquid. Stop buying gifts, generosity, and social obligations at a level that weakens your own future. Generosity matters, but generosity without boundaries becomes financial leakage. Many people stay broke because they need to appear generous in every social setting, every holiday, every event, every family request. Here is the strategic reasoning. Money given from strength can be noble. Money given from fragility is often pressure, guilt, or identity management. If you are still building your capital base, your first responsibility is to stop your own future from becoming dependent on luck. Stop buying monthly payments as if they are harmless because they feel smaller than upfront prices. This may be the most important category of all. Monthly payments are how people anesthetize themselves to total cost. Car notes, financed electronics, premium memberships, installment plans, luxury services, subscriptions layered on subscriptions. When a purchase is translated into monthly language, people stop evaluating the underlying economics. But markets do not care how you emotionally frame the outflow. They only care that capital left the system. Your future wealth is being sold one easy payment at a time. Now you need to see how to apply this in the real world, because recognition alone is not enough. Start with an audit, not with guilt. Look at the last 6 to 12 months of spending and categorize each expense by function. Did it preserve health, support income, reduce genuine risk, or build assets? Or did it mainly create short-term comfort, social appearance, or emotional relief? If you do this honestly, patterns appear quickly. You will see that your problem is probably not one giant purchase. It is a repeated capital misallocation process. Once you see the pattern, you create response rules. If the purchase raises a recurring fixed cost, you slow down and test it harder. If the purchase is driven by urgency, you force a waiting period. If the purchase is meant to impress other people, you assume the value is lower than it feels. If the purchase is hard to explain in terms of future cash flow, reduced risk, or lasting utility, you treat it as discretionary and subject it to tighter limits. This is the same logic you use in portfolio management. If the market moves sharply higher and sentiment becomes euphoric, you reduce emotional reaction and return to valuation. If spending temptation rises because income rose, you react by increasing your savings rate first, not your lifestyle. Here is the discipline sequence. Before discretionary spending grows, reserves grow. Before lifestyle expands, investments expand. Before visible upgrades appear, invisible strength appears. That means emergency liquidity first. high-interest debt reduction second, automated investing third. Only then do you let lifestyle improve, and even then you do it in proportion to the durability of your cash flow. If your income is variable, your spending should be conservative. If your income is stable and your investment base is growing, you can loosen constraints gradually, but you never let fixed commitments outrun asset formation. Position size matters here just as much as in investing. A single bad spending decision can be survivable. A cluster of medium-sized bad spending decisions can quietly trap you for years. That is why timing matters. If you get a raise, a bonus, or a strong income month, do not respond by upgrading multiple categories at once. That is lifestyle leverage. If the market moves lower and creates opportunity, you want available capital. If the economy weakens and your income becomes less certain, you want low burn. If interest rates remain elevated, you want flexibility more than vanity. This is where most people stop, but this is the advanced level. The advanced level is understanding second-order effects. A purchase is rarely just a purchase. It changes future expectations, future obligations, future behavior, and future decision quality. Buy the expensive car, and now you protect that identity with more expensive habits. Move into the oversized house, and now your baseline stress level changes because your burn rate changed. Start making speculative bets, and now your brain becomes more sensitive to noise, headlines, and volatility. The first decision alters the entire system. This is how correlation breakdown happens in personal finance. Income pressure, rising rates, larger fixed costs, poor liquidity, and emotional spending all begin reinforcing each other. That is the household version of a liquidity trap. You look wealthier from the outside and become weaker on the inside. Bankruptcy risk mathematics is not mystical. The probability of failure rises when fixed costs grow, liquidity falls, debt service increases, and capital gets locked into low utility or illiquid decisions. Rich people are not merely high earners. They are people who avoid chains of commitments that reduce adaptability. There is also a behavioral trap here. Once you cut obvious waste, you may start to feel superior. That can be dangerous. You might stop buying small, foolish things, then justify one large, foolish thing because you believe you have earned it through discipline. Be careful. Overconfidence often arrives disguised as maturity. Keep your rules. If a purchase would materially reduce your investable capital, it deserves scrutiny, no matter how disciplined you were last month. If a speculative position grows too large because it is performing well, trim it. Do not let a good outcome rewrite a good process. Now let's integrate this into a system you can actually maintain. Practice the skill by journaling purchases before they happen. Write down what the item costs, what recurring obligations it creates, what problem it solves, what cheaper alternative exists, what asset purchase it displaces, and how long the satisfaction is likely to last. Then reverse test it. Ask yourself what happens if your income falls 20%, if markets offer better opportunities next quarter, or if an unexpected expense arrives right after this purchase. If the decision still looks strong under stress, it is probably functional. If it only works in a calm environment, it is probably emotional. Maintain the skill with a review loop. Every month, track your savings rate, fixed cost ratio, investable surplus, and the percentage of spending that improved long-term resilience versus short-term comfort. Every quarter, review whether your consumption is drifting faster than your asset base. Every year, measure whether lifestyle upgrades were matched by real growth in owned capital. Those metrics matter more than appearances because they tell you whether your system is compounding or leaking. Combine this with other tools. Valuation teaches you not to overpay, whether for stocks or for lifestyle. Macroeconomics teaches you when liquidity and rates make flexibility more valuable than aggression. Technical analysis, used appropriately, can help you stage entries in markets instead of forcing capital at weak moments. Risk management teaches you that survival comes before upside. The same framework works in spending. You do not need perfect decisions. You need durable decisions. Test this under pressure. Use a simulated budget where you remove 10 or 20% of your income on paper and see which purchases immediately feel indefensible. Run a small-scale experiment where you pause one discretionary category for 60 days and redirect the cash into investments or reserves. Watch what changes. Notice whether the sacrifice was real or mostly psychological. Track how quickly your mind adapts. The adaptation itself teaches you something important. Many of the things you think you need are just habits with branding attached. And here's the subtle part worth revisiting, because it sits underneath almost every bad purchase on this list. Most people do not buy these 10 things because they are irrational in the moment. They buy them because each one offers a fast identity upgrade. It lets you feel successful before your balance sheet is actually strong. That is why the discipline matters so much. Real wealth is delayed visible proof of invisible restraint. Once you understand that, the decision stops being about denial and starts being about ownership.